While everyone's watching stocks, the bond market just made a $2 trillion bet that could reshape your portfolio in 2024. Here's what Wall Street insiders know that you don't. Right now, something fascinating is happening in the bond market that most investors are completely missing. Treasury bonds are rallying hard, with yields dropping across the curve. The 10-year Treasury yield fell below 4.2%, and the 2-year dropped even faster. What does this mean in plain English? Bond traders are betting enormous sums that the Federal Reserve will start cutting interest rates sooner than expected. When bond yields fall, bond prices rise. It's an inverse relationship. And institutional investors don't move billions without conviction. These aren't retail traders making emotional decisions. These are pension funds, hedge funds, and sovereign wealth funds repositioning massive portfolios based on economic data the rest of us haven't fully digested yet. The bond market is essentially a crystal ball for Federal Reserve policy, and right now it's predicting rate cuts could start as early as mid-2024. Here's why this matters. The Fed has held rates at 5.25% to 5.5% for months, the highest level in 22 years. But inflation has cooled from 9.1% in June 2022 to around 3.2% now. That's still above the Fed's 2% target, but the trajectory is clear. Bond traders are looking at weakening economic indicators, a cooling job market where unemployment ticked up to 3.9%, and slowing consumer spending. They're connecting dots that suggest the Fed's inflation fight is nearly won. When the Fed cuts rates, it's like releasing pressure from the economy. Borrowing becomes cheaper, businesses invest more, and existing bonds with higher rates become more valuable. Here's where things get counterintuitive. You'd expect gold to surge when rate cut expectations rise, but it's actually slipping, down nearly 1% to around $2,020 per ounce. This seems backwards at first. Gold typically benefits from lower interest rates because it pays no yield. When rates fall, the opportunity cost of holding gold decreases. So what's happening? The answer lies in the dollar. The US dollar index has been surprisingly resilient, hovering near recent highs. Gold is priced in dollars globally, so a strong dollar makes gold more expensive for international buyers, reducing demand. Additionally, some traders are taking profits after gold's impressive 13% gain in 2023. They're rotating capital from gold into bonds, which now offer attractive yields with potential for capital appreciation if rates actually fall. Let's translate this into actionable insights. If you're holding cash in high-yield savings accounts earning 5%, that rate won't last if the Fed cuts. Banks will quickly lower savings rates. Bonds become more attractive in this environment, but timing matters. Buying bonds now means locking in current yields while potentially benefiting from price appreciation when rates fall. However, there's risk if inflation rebounds or the Fed holds rates longer than expected. For stock investors, rate cuts typically boost equity markets, especially growth stocks and real estate investment trusts that benefit from cheaper borrowing. But the reason for rate cuts matters. Cuts to stimulate a weakening economy are different from cuts after successfully defeating inflation. The bond market is betting on the latter scenario, which would be genuinely positive for risk assets across the board. Before you rush to reposition your portfolio, consider what could go wrong with this consensus trade. First, inflation could prove stickier than expected. Oil prices remain volatile, housing costs are still elevated, and wage growth continues above historical norms. If inflation reaccelerates, the Fed would hold rates higher for longer, causing bond prices to fall and yields to rise. Second, economic data could surprise to the upside. Strong GDP growth or robust job creation might convince the Fed that restrictive policy is still necessary. Third, there's geopolitical risk. Escalating conflicts or trade tensions could disrupt supply chains and reignite inflationary pressures. The bond market has been wrong before. In early 2023, traders priced in multiple rate cuts that never materialized. The lesson? Market expectations don't equal certainty. Smart investors prepare for multiple scenarios rather than betting everything on one outcome. So what are sophisticated investors actually doing right now? According to recent SEC filings and fund flow data, institutional investors are extending bond duration, meaning they're buying longer-term bonds to maximize potential gains from rate cuts. They're also diversifying across the yield curve rather than concentrating in one maturity. In equities, there's rotation toward rate-sensitive sectors like utilities, REITs, and small-cap growth companies that struggle with high borrowing costs. Interestingly, hedge funds are also increasing positions in volatility instruments, essentially buying insurance against their bullish bets. This suggests even the smart money acknowledges uncertainty. The key takeaway isn't to blindly copy these moves, but to understand the logic. They're positioning for the most probable outcome while hedging against alternatives. That's the difference between speculation and strategic investing. The bond market is sending a clear signal, but wise investors listen while keeping their risk management intact. If this breakdown of bond market signals and Fed policy helped clarify what's really happening in markets right now, smash that like button and subscribe for more no-nonsense financial analysis. Drop a comment telling me how you're positioning your portfolio for potential rate cuts. Are you buying bonds, rotating into rate-sensitive stocks, or staying cautious? Let's discuss